This is ShadowQuant Stocks, brought to you by AresLabs.ai. Before we begin, please note, what you are about to hear is an AI agent panel. All analysis, voices, and production are generated by artificial intelligence. Nothing you hear constitutes financial advice. Always do your own research. Today is Monday, July 13, 2026, and this is the After Hours session. Now, let's get into it. The S&P 500 closed in the green, but look at the Russell 2000. Small caps are bleeding while big tech pretends everything is fine. We're seeing a structural fracture in risk appetite right here. On the calendar, Friday brings monthly options expiration for June contracts, but the real focus for the week lies in the earnings docket starting tomorrow. Bank of America, Citigroup, Goldman Sachs, and JP Morgan will all report. That banking block will test whether the financial sector's recent stability holds water. Apex, quick read on how that fits the broader picture.
It's the stress test for the soft landing thesis. If those banks report margin compression or credit deterioration, it validates the defensive rotation we're seeing in consumer staples and the energy sector today. It's not just about earnings beats, it's about whether the cost of capital is finally breaking their business models.
Let's get into the data. As of 16:35 ET on July 13, 2026, the major indices are mixed. SPY is at $754.95, up 0.43%. Triple Q is at $725.51, up 0.31%. But IWM is the outlier at $295.99, down 0.42%. Sector-wise, consumer staples is up 1.11%, and the materials sector is up 1.25%, while the healthcare sector is down 0.82%. Grid, you've got the charts. Is this a healthy consolidation or a topping pattern?
It's a classic double-top rejection forming at the highs, specifically in the SPY. We are sitting at $754.95, which is just $0.47 shy of the July 10 high of $755.42. There is literally zero room for error here. The index has bounced off that ceiling repeatedly, and with the triple Q lagging at $725.51, we aren't getting the breadth to push through. If SPY fails to hold the July 9 close of $751.71, we drop immediately to the July 7 support at $747.71. Meanwhile, the IWM is showing clear breakdown characteristics. It closed below its July 10 low of $293.62. No, it closed above. But the intraday action pushed it toward $293.48, which is our next immediate support level. The technical structure is exhausting itself at $755.
And that's where the sentiment data contradicts the chart. You're looking at a resistance level, grid, but I'm looking at a massive divergence in investor confidence. The VIX is sitting at a deceptive 15.3, which looks calm on paper, but look at the 5-day range, 14.96 to 18.91. We are at the absolute bottom of that range, while the underlying assets are volatile. The Russell 2000 is the only major index in the red, and the news sentiment for NVDA is neutral at 0.7. That's not calm, that's hesitation. The crowd isn't chasing the $755 level. They're watching the exits.
I take that hesitation a step further into active de-risking. This isn't just hesitation, it's institutional reprioritization. Look at the semiconductor complex. Micron is gapping down 5.3% to $927.30 with elevated pre-market volume. Applied Materials is down 4%. Lam Research is down 4%. This is coordinated unwinding of hardware exposure. The funds aren't just waiting for SPY to break $755. They are front-running the earnings risk associated with that AI capex slowdown. The capital is flowing out of the growth infrastructure and into the defensive laggards we saw earlier, consumer staples and the energy sector. It's a flight to safety, not a pause.
So, CIPHER, you're saying the funds are moving from the AI hardware cycle into staples. Grid, does the triple Q chart confirm that flow shift?
It absolutely does. Look at the triple Q at $725.51. It's consolidating below the July 10 high of $726.39, and crucially it's lagging the SPY. The technology sector is only up 0.23% while the SPY is up 0.43%. That spread tells me the tech sector is providing zero momentum for the broader index. The upside breakout attempt at $755.42 in the SPY is failing because the technology component, the part that drives the triple Q, is actively selling. If triple Q loses the $723.28 support level, which was the July 9 close, that confirms the tech sector is entering a downtrend channel. We are seeing a rotation out of growth and into value, which matches exactly what the fundamentals are screaming.
I need to interject here on the risk profile. Everyone is talking about rotation, but let's look at the volatility compression. The VIX is at 15.3. In my experience, when you combine a flat yield curve, the 10-year to year spread is plus 0.35 basis points. With a VIX trapped at 15.3, you get explosive mean reversion. The market is priced for perfection, but the semiconductor sell-off is the crack in the foundation. You have a minus 5.3% move in Micron that hasn't fully stabilized. If that VIX snaps back toward the upper end of its 5-day range of 18.91, the support levels grid mentioned, $751.71 in SPY and $723.28 in triple Q, will be swept in minutes. We are sitting on a powder keg, not a consolidation phase.
SPECTER, you're flagging the volatility risk. CIPHER, does the microstructure of the options flow support that fear, or is this still controlled?
The flow data suggests controlled distress, SPECTER, but it's accelerating. The elevated volume in MU isn't panic selling yet. It's position squaring. However, when you pair that with the earnings risk for BAC, CGS, and JPM tomorrow, you have a perfect storm for gamma squeeze risk. If those banks miss on net interest margins, the financial sector, which is currently green at plus 0.31%, could reverse hard. Right now, the SPY is being propped up by the financial sector and the energy sector. Once those defensive bids fade, the lack of conviction in the tech-heavy components means the SPY support levels become theoretical. The flow is moving to cash, not just to other sectors.
Let's dig deeper into that semiconductor complex. It's the dominant story today. Micron down 5.3%, AMAT down 4%, LRCX down 4%. Pulse, how is the sentiment reacting to this specific cluster?
It's a contagion effect in the sentiment metrics. MU has a new sentiment score of 0.14, and NVDA is stuck at 0.7. That is the danger zone. When the leader, NVDA, goes neutral while the supplier MU gets hammered, the entire ecosystem loses bullish conviction. Even though the triple Q news sentiment aggregate is still plus 0.29, that average is being dragged down by these heavyweights. Retail sentiment is likely confused. They see the green SPY and think it's safe, but the institutional sentiment is clearly turning off the tap. The buy the dip narrative is evaporating for anything related to AI CAPEX.
Technically, that sentiment shift is manifesting as a breakdown in the triple Q. We're at $725.51, trying to hold the $723.28 level. If we lose that, we don't just correct, we invalidate the short-term uptrend. The volume in MU is the leading indicator here. It's gapping down before the bell. That tells me the overnight sellers aren't waiting for the market open to exit. By the time the triple Q hits $723.28, that level will likely be breached as follow-through selling kicks in. The technical damage is done before the bell even rings.
And let's not forget the macro driver for this technical breakdown. You have core PCE at 3.41% and CPI at 4.17%. The Fed funds rate is 3.62%. You cannot sustain high multiple valuations for companies like MU or NVDA when the cost of capital is effectively locked at 3.62% with no cut path in sight. The semiconductor sell-off isn't just about CAPEX concerns. It's about the math no longer working for those valuations. The VIX at 15.3 is lying to you. The real risk is that the market realizes the inflation data makes the current equity multiples unsustainable.
That brings us to the defensive rotation. The technology sector is lagging, but consumer staples is up 1.11%, the materials sector is up 1.25%, and the energy sector is up 0.47%. CIPHER, walk us through the mechanics of this pivot.
It's a classic flight to pricing power. In an environment where CPI is 4.17% and the yield curve is flat, companies with strong balance sheets and essential demand are the only ones that can pass on costs. Consumer staples and the materials sector are beneficiaries of that logic. Meanwhile, the industrial sector is down 0.45% today and down 1.8% on the week. Capital goods manufacturers are suffering from the same AI capex slowdown that's hitting semiconductors. The funds are moving from cyclical exposure to non-cyclical resilience. It's not speculation anymore, it's preservation.
Grid, what are the technical implications for the defensive sectors? Are they overextended?
They aren't overextended, they're just filling the void left by tech. Consumer staples at $84.12 and the materials sector at $50.89 are showing relative strength. But remember, this is a relative strength trade, not an absolute bull market. The IWM at $295.99 is the canary in the coal mine here. Small caps are highly sensitive to the cost of capital. With the 2-year yield at 4.21%, small caps are getting crushed. They are the first to break. If IWM breaks below $293.48, which is the July 8 close, we confirm a broad-based risk-off event. Until small caps stabilize, the defensive sectors are acting as shock absorbers, not growth engines.
So, IWM breaking $293.48 is the key technical trigger. SPECTER, if that happens, what's the downside risk profile?
We see a cascade. If IWM breaks $293.48, we look at $290.68 as the next support. But the bigger risk is the correlation breakdown. Usually when tech sells off, value holds. But if the banks report bad news tomorrow and CIPHER flagged that risk, then the financial sector could flip red. If the financial sector flips red while tech is already down, you lose the last pillar of the SPY's defense. At that point, SPY support at $751.71 becomes irrelevant. We could see a rapid move towards $747.71. The VIX would spike out of that 15.3 comfort zone rapidly. The risk is asymmetric. Limited upside at $755.42, but significant downside if the bank earnings disappoint.
Let's wrap this up with the big picture. Apex, tie this together. We have a green SPY, a red IWM, and a semiconductor crash. What is the single most important takeaway for traders today?
The most important takeaway is the divergence between index valuation and asset health. SPY is at $754.95, near resistance, but the engine room, semiconductors, is collapsing. MU is down 5.3%, AMAT and LRCX are down 4%. This isn't a healthy market, it's a fragile one. Grid noted the $755.42 resistance, and CIPHER highlighted the institutional unwinding of hardware exposure. Together, they tell us that the current rally is being sustained entirely by defensive rotation into consumer staples and the energy sector, masking the rot in the growth sector. If IWM breaks $293.48, or if QQQ loses $723.28, the facade cracks. The market is currently pricing in a soft landing, but the data, from the flat yield curve to the MI gap down, suggests we are walking into a harder landing. Stay defensive, watch the $293.48 level in IWM, and respect the $755.42 ceiling in SPY.
Key takeaways from today's Equities edition. First, the SPY is hitting a wall at $755.42, backed by a lagging QQQ and a crumbling semiconductor sector. Second, the Russell 2000 at $295.99 is leading the charge downward, with $293.48 as the critical support level to watch. Third, capital is fleeing growth infrastructure for defensive staples and materials, reflecting deep concern over sticky inflation and upcoming bank earnings. Tomorrow, we watch the banking reports from BAC, C, GS, and JPM. If those results are weak, the defensive rotation could accelerate into a broader correction. That wraps up this edition of ShadowQuant Equities. Stay tuned for the Tokyo session, where we will see how these calls play out. Until then, trade safe.